Global markets are currently exhibiting a pattern known as sideways movement. This market behavior indicates that prices are fluctuating within a relatively narrow range. There is no clear upward or downward trend in asset values. Sideways movement suggests a period of consolidation or indecision among market participants. This pattern reflects a lack of strong conviction among investors. Investors are uncertain about the future direction of the market. Sideways trading, also known as a horizontal trend, occurs when prices move within a narrow range. This market behavior indicates a state of heightened uncertainty among participants. Various economic factors contribute to this uncertainty, creating conflicting signals. Geopolitical events also play a significant role, adding to market indecision. As a result, neither buyers nor sellers exert a dominant force on prices. Consequently, there is no clear upward or downward trend driving market prices in a singular direction. A primary driver of global economic uncertainty is the increasing prevalence of geopolitical tensions worldwide. These tensions encompass various forms, including trade disputes between nations. Regional conflicts also contribute significantly to this global instability. Such geopolitical events introduce unpredictability, impacting global economic stability and growth. Geopolitical events can significantly disrupt established supply chains. These disruptions lead to unforeseen costs and delays for businesses. Such interruptions directly impact corporate earnings and profitability. Consequently, these effects extend to influence stock market performance. Geopolitical tensions significantly influence global financial markets and investor behavior. Such tensions often lead to heightened uncertainty, impacting investment decisions. Investors typically adopt a wait-and-see approach during periods of geopolitical instability. This cautious stance reflects an increased aversion to risk among market participants. Many investors prefer to hold cash or allocate funds to less volatile assets. This strategy persists until greater clarity emerges regarding the geopolitical landscape. Increased risk aversion among investors leads to a shift in capital allocation. Capital moves away from riskier assets, such as equities or emerging market investments. Funds are redirected towards safer havens, including government bonds or stable currencies. This shift contributes to market stagnation and a reduction in overall trading activity. Low trading volumes are a critical factor contributing to market uncertainty. Trading volume refers to the total number of shares or assets exchanged in a market over a period. When trading volumes are low, fewer transactions occur for a given asset. This scarcity of trades makes it challenging to accurately determine fair market prices. With limited activity, even small trades can disproportionately influence price movements. Consequently, low trading volumes often lead to increased price volatility and reduced market liquidity. The bid-ask spread is the difference between the highest price a buyer will pay and the lowest a seller will accept. Low liquidity in a market is characterized by infrequent trading and low trading volume. When liquidity is low, there are fewer buyers and sellers, leading to less competition. This reduced competition often results in a wider bid-ask spread. A wider spread indicates less efficient transactions, as the cost of trading increases for participants. Low liquidity environments occur when there are few buyers and sellers in a market. In such conditions, even small trades can significantly impact asset prices. This disproportionate impact leads to increased price volatility, causing rapid fluctuations. Investors face challenges executing trades without moving the market significantly. Macroeconomic hesitation describes a state of uncertainty in the economic landscape. This uncertainty is primarily driven by ambiguity surrounding key economic policies. It also stems from unclear signals from critical economic indicators. Central banks, for example, face complex decisions regarding inflation control. Their choices on interest rates contribute significantly to the economic outlook. Such policy dilemmas create an environment of an unclear and unpredictable economic future. Persistent inflation is a key economic challenge, eroding purchasing power and increasing living costs. Central banks respond with aggressive interest rate hikes to combat rising prices and stabilize the economy. These measures raise concerns about potential economic slowdowns or even recession. Such uncertainty directly impacts corporate investment decisions and consumer spending patterns. Governments worldwide face complex fiscal challenges in managing their economies. A primary concern is the escalating level of national debt, impacting long-term economic stability. Budgetary constraints further complicate fiscal management, limiting government spending options. The effectiveness of current fiscal policies remains a subject of ongoing debate and uncertainty. This ambiguity in fiscal policy direction contributes to overall market uncertainty and volatility. Accurately projecting future economic growth is challenging due to various macroeconomic factors. The confluence of these factors creates an unpredictable economic landscape. This unpredictability hinders effective planning for businesses. Investors also struggle to make informed decisions in such an environment. Uncertainty often poses a greater threat than specific bad news in market dynamics. Specific bad news can be quantified, allowing for clear assessment and integration into market pricing. This quantification enables markets to adjust effectively, leading to a subsequent recovery. In contrast, uncertainty lacks definable parameters, making it difficult to price or react to. The inability to quantify uncertainty can lead to prolonged market instability and delayed recovery. When investors encounter known bad news, they can make informed decisions. These decisions aim to mitigate potential risks or identify new opportunities. The market then processes this new information from investor actions. This processing leads to the establishment of a new market equilibrium. Uncertainty is often compared to a dense fog, obscuring visibility and clarity. This fog prevents a clear assessment of the path ahead in economic or business contexts. It makes it impossible to accurately evaluate potential risks associated with decisions. Similarly, identifying new opportunities becomes challenging when the future is unclear. This lack of clarity leads to paralysis, hindering confident investment decisions. Ultimately, such paralysis contributes to market stagnation, impeding growth and progress. Professional investors adapt strategies during periods of high market uncertainty. Such periods often lead to a shift from aggressive growth to defensive investment approaches. Defensive strategies prioritize the preservation of existing capital over seeking high returns. This approach aims to minimize potential losses and protect portfolio value. It typically involves investing in stable assets with lower volatility and consistent performance. The goal is to navigate market downturns while maintaining financial stability for the investor. Portfolio diversification is a key strategy in investment management. It involves spreading investments across various asset classes. This includes different sectors of the economy and also across diverse geographical regions. The primary goal is to distribute and mitigate investment risk. This reduces the impact of any single negative market event on the overall portfolio. During periods of market uncertainty, professional investors often adjust their portfolio strategies. A common tactic is to increase cash holdings within their investment portfolios. This strategic move provides significant financial flexibility. It allows investors to remain agile and responsive to market shifts. When market clarity returns, this cash can be deployed to acquire undervalued assets. This approach aims to capitalize on future opportunities as market conditions stabilize. Investors may strategically reallocate their portfolios towards defensive sectors. These sectors include utilities, consumer staples, and healthcare industries. Such sectors exhibit reduced sensitivity to broader economic cycles. They also demonstrate greater resilience against geopolitical shocks and market volatility. Robust risk management is crucial for financial stability and protecting investments. This involves setting clear stop-loss orders to limit potential losses on trades. Continuous monitoring of market volatility is essential to adapt to changing conditions. Regular reevaluation of portfolio exposures helps manage overall risk effectively. Long-term value investing is a strategy employed by professional investors. It focuses on identifying companies with strong fundamental business models. These companies' stock prices are often temporarily undervalued due to market uncertainty. Investors believe these underlying strong companies will eventually recover. The recovery is anticipated when market conditions improve or uncertainty dissipates. This approach aims for capital appreciation over an extended investment horizon. Alternative investments encompass assets beyond traditional stocks, bonds, and cash. Examples include real estate, private equity, commodities, and hedge funds. These investments are often integrated into professional strategies for portfolio diversification. They can potentially offer a hedge against market volatility, enhancing overall portfolio resilience. Continuous and thorough market research is fundamental for informed investment decisions. Professional investors allocate substantial resources to analyzing economic data. This analysis extends to geopolitical developments, which influence market stability. They also scrutinize corporate fundamentals to gain an informational advantage. Global markets often experience periods of significant uncertainty, driven by various factors. Understanding these underlying drivers is crucial for effective financial decision-making. Professional investors employ specific strategies to navigate these challenging market conditions. These strategies aim to mitigate risks and identify opportunities amidst volatility. Individuals can leverage this knowledge to empower their own investment choices. Informed decisions lead to more resilient and successful personal financial portfolios.